Thanks for tuning in, folks. This is Tyler Mordy, President and CIO at Forstrong, and I'm pleased to share with you a short update on our portfolios for the month of January. Well, 2018, as everyone knows, ended with a thud. As you can see in this chart, almost nothing outperformed the safety of US Treasury bills in 2018. And the last time this happened was nearly 40 years ago, and before that, during the 1910s. So all told, the year ended with no major asset class registering even a gain of 5%. This was the first time this has happened in 50 years. And one of the only winners in 2018 was, of course, volatility which was up almost 70%. So 2018 will likely be remembered as a year like 1962 or 1987. These years also had large drops outside the context of an economic recession. And historically, these are once in 20 to 30 year outcomes. Now, performance was tough last year for portfolio managers, but global diversification did continue to work and importantly avoided any large drawdowns or big mistakes, as we like to call them. Keep in mind that some equity markets were down 20% and more. For the TSX, it was a little less at minus 8.9%. And there were pockets of devastation in US technology, energy, and the entire crypto space, of course, but two of our mandates actually had a positive return for the year. And to put some comparisons on that, a Canadian domicile investor did very poorly. A Canadian balanced portfolio with 50-50 stock bond content would have returned a negative 5.1%. And all of our portfolios did considerably better than that. And of course, our 15-year plus track record remains very good with a history of low downside protection, as we call it, and long-term outperformance. Now, it's important to bear in mind just how negative 2018 ended. Investors dumped equities on a truly unprecedented scale. This chart shows that in the US, we saw a record outflow out of active equity mutual funds, which is remarkable considering this happened outside an economic recession. The same is true for global growth expectations, which utterly collapsed into the end of the year. And to be sure, there is real risk that the end of cycle fears become self-fulfilling and feed into a more serious downturn. But, global macro growth expectations are now the most pessimistic they've been in 10 years, more so than at the major equity bottoms in 2011 and 2016. And our investment team believes US economic and earnings growth will slow steadily over the next 12 months, but it will be more gradual and modest than most investors fear. Looking around the world, China's slowdown is already ending in response to easier policy, and the economy is likely to accelerate back to an above trend pace. Further, the euro area's soft patch is also likely to give way to firmer data aided by currency weakness and stronger growth in Asia. And in short, what we're saying is that world growth is likely to settle back to a simmer from the somewhat anomalous high growth we saw in the US last year. But if you combine the stabilizing growth story with deeply depressed sentiment, then a series of upside surprises becomes highly probable throughout 2019. This is very similar to the post-crisis corrections we saw again in 2011 and 2014 to 2015. Each of those coincided with significant economic downturns and adjustments. Investor expectations were lowered, valuations were improved and restored, and importantly, monetary policymakers learned painful lessons that economies remain vulnerable and must be supported with dovish policy. We're not in the same environment as the pre-financial crisis, where to hang some numbers on it, the US GDP growth averaged 3.5%. The longer term trend now, post-crisis, is closer to 2%. But looking back to each of these periods, 2011, 2016, they provided renewal and rebirth, breathing life back into what we now call born again bull markets. We don't think this episode will be any different. So on to portfolio positioning, we have recommended for some time that investors continue to rotate away from the United States, where the currency valuations, the stock market valuations are very expensive and expectations are high. And we've recommended to rotate into global markets like Japan, China, and even Europe, where valuations are quite compelling, particularly in the emerging markets, and expectations for those regions are extremely low. And in fact, in September 2018, we penned a note outlining this key opportunity and urged investors to look beyond the short-term noise of trade wars. This worked out really well. Emerging market stocks have been outperforming US stocks since then, and even emerging market bonds have been stable and were up substantially through a difficult fourth quarter. So we continue to hold this view for our clients. As you can see in the portfolio matrix below, our largest convictions are underweight the United States and overweight international stock markets, with an overall bias for equities over bonds. So it's sort of a risk-on portfolio. And for more information on our portfolio positioning, you can always follow our monthly portfolio update, which outlines key themes and holdings and really gets into the weeds of the portfolios. And please visit our Global Thinking blog, which contains all of our media and publications. And in particular, if you have not read our annual Super Trends report called Written in Stars this year, I'd encourage you to check that out to get our more comprehensive global outlook. Thanks very much for listening and for your continuing partnership, and we look forward to updating you next month.